Give a monkey enough darts and he'll beat the market. Wait, what? It all started in 1973 when Burton Malkiel, the author of today's book, claimed that a blindfolded monkey throwing darts at the newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by the experts. So a group of researchers from the research affiliates decided to test this random theory. They put 100 monkeys to throw darts at stock pages in newspapers. And here's what happened. The average monkey outperformed the index by an average of 1.7% per year since 1964. And I know what you're thinking, that is pure bananas, right? But before you run down to the local pet store and order your dart-throwing, money-making monkey, consider spending the next few minutes learning why you're better off putting your money in a passively managed index fund from someone with years of practical experience on Wall Street. And of course, I mean the author, not me. My experience with Wall Street boils down to walking on it and taking pictures. Before we begin to make the right decisions about how to invest your money, you must know how stocks are valued. And traditionally, there's two theories of asset valuation: the firm foundation theory and the castle in the air theory. Let's start with the firm foundation theory. Enthusiasts of this theory will argue that assets have what's called an intrinsic value based on their present conditions and future potential. For instance, if an asset is a common stock, they will calculate the intrinsic value by summing the value of the present dividends and the estimated growth of the dividends in the future. They will then make buying and selling decisions based on the actual price of the stock and its intrinsic value, because they believe the price will eventually regress to the intrinsic value. If the stock price is below the intrinsic value, the investor will buy more shares. If it's above, they sell. While this theory has earned its share of proponents, among them people like Warren Buffett, it is flawed because, according to the author, no analyst can know for certain how much or how long a stock's dividend will grow, or if it's going to grow at all. Next is the castle in the air theory. And it sounds a little bit funny, but this theory states that an asset is only worth what someone else will pay for it. In other words, no asset has an intrinsic value that can be determined analytically or mathematically. Rather, the value of an asset is purely psychological. The concept was developed by the famous economist John Maynard Keynes, who invested based on what he thought other investors would value. For instance, if he sensed optimism in the steel production, he would invest in steel companies regardless of their foundation because he anticipated other investors would soon rush into the steel. The key to the castle in the air theory is timing. The successful investor will buy an asset just before mass enthusiasm causes its price to rise and sell right before that enthusiasm wanes. And talking about timing, this is a fantastic time to smash the like button and give a like to this video. And to some, I understand all of these theories might sound a little bit dense, so let's illustrate them with apples. Say you own a farm and you plant an ordinary green apple tree. It produces garden variety green apples that you can now sell. Now, let's say that you get fancy and you plant an organic green apple tree next to it. It still produces green apples, but they're much bigger, much greener, and they taste better. According to the firm foundation theory, your organic apple tree is a better investment because it produces better products that you can charge more for and hence make a bigger profit. Now let's imagine that a person comes to your farm looking for red apples. They're making a Pinterest-worthy apple pie that requires red apples. They don't care for your juicy organic green apples, even if you offer them at a discount. They need red apples, and they're willing to pay whatever it takes just to get them. And this is where the castle in the sky theory kicks in. It would argue that it does not matter how good the green organic apples are if a person needs red ones. In this case, the red apple is worth more to an individual, so the price is not driven by the quality of the apples themselves, but the psychology of the investor. In this case, the pie maker. Unfortunately though, according to the book, both theories are flawed, and neither of them can be a reliable predictor of the market. But there must be some methods of analysis to predict the movement of the stock price, right? Or maybe not. Let's see the most common ones: the technical analysis and fundamental analysis. Technical analysis relies on stock charts, graphs of past price movements and trading volumes to predict future price movements. Technical analysts subscribe to the castle in the air theory of asset valuation. They believe that stock prices are more a product of investor psychology than a sober accounting of a firm's profit-making potential. They follow two core principles. 1. all economic data is reflected in a stock's past price. And 2, stock prices follow trends. For example, if a price is rising, it would continue to rise, or if it's falling in a predictable pattern, it will continue to fall. Well, unless it doesn't. And here's the issue. According to the author, the technical analysis doesn't work, simply because the stock's past does not reliably indicate the future. It's almost like flipping coins. If you flip 50 coins, you might find some trends in the chart. Still, for all we know, there's always a 50% chance one will flip either head or tail. The other major method of stock valuation is what's called fundamental analysis. It takes into account a number of factors in addition to past price movements, which will make it seem to be a little bit more superior to technical analysis. Unfortunately, studies have shown that it just is unreliable, and here's why. Randomness is inevitable. No matter how accurate the analysis seems, one can never predict for sure anything, like a new legal regime, the appearance of a groundbreaking technology, or even a Reddit post that will break the entire market. And 2, the firm's accounting creativity. The evaluations are based on the relevant information given on and from the company itself, which means the evaluation will be just as good as the information given. So if a company fabricates a high quarterly earnings report, for example, or does some accounting sleight of hand, you as an investor will always be up for a nasty surprise. Okay, so if the market is so random that neither fundamental nor technical analysis nor some combination of the two can accurately predict it, what can you do? The idea of investing your hard-earned cash in a random market doesn't seem very appealing, does it? However, the author gives 2 lessons that can help you succeed. 1, be rational. Being a great investor depends on much more than just technical knowledge about the market. The importance of psychology has become more and more evident in the past decades. Here are 4 key points to learn from behavioral psychology to help you become a better investor. 1, do not follow the crowd. If everyone is getting out, stay in. If the market is hot, stay out. 2, do not overtrade. Try not to be overconfident, as that will lead to overtrading, which means paying extra fees, and there is a much more likely chance of you making a mistake. 3, sell losers, not winners. If you do decide to trade, make sure you sell your losers, not your winners. And 4, do not fall for the IPOs. Studies have shown time and time again that IPOs underperform the market by as much as 4% per year. And it's very common to see an IPO value drop exactly 6 months after going public, the date when insiders are finally allowed to unload their stock. And the second big principle is buy and hold. If you could remember just one thing from today's video, it should be this. Buying and holding under a diverse portfolio will almost always outperform experts' advice in the long run. In other words, you're better off putting your money in a passively managed index fund than trading stocks yourself or investing in an actively managed mutual fund. And here's an example of how this works out. Let's say that in 1969, investor A puts $10,000 into the S&P 500 index fund. In 2018, the same investor would have, without investing any more money, more than $1 million. Pretty good, right? At the same time, back in the same 1968, investor B puts in the same amount of money in an actively managed fund. In 2018, this investor would have $817,000, which is a lot of money, but a lot less than investor A. And let's say that at the same time, investor C decides to buy and sell stocks himself. Unfortunately for them, studies show that as much as 90% of people lose completely all their money in the stock markets if they're given enough time to make mistakes. So you see, nobody really knows what will happen in the market in 10 years, 6 months, or even in a couple of hours. If you've ever watched the movie The Wolf of Wall Street, you remember Matthew McConaughey's character saying, "Number one rule of Wall Street, nobody, and I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if a stock is going up, going down, sideways, or in circles. It's all fugazi." Put simply, the market behaves randomly, hence the name of the book. I don't know if it's fugazi or not, but the author once said, "It is not hard to make money in the market. What is hard is avoiding the alluring temptation is to throw away your money on short, get-rich-quick speculative binges. It is an obvious lesson, but one frequently ignored." And right now you're probably super motivated. You got all this great information, but guess what? Motivation does not pay the bills. So let's jump into the next video and let me show you the action steps. How do you actually implement this today in 2021? Click here on the next video and I'll see you there.